Metropolitan Real Estate Equity Management has focused on private real estate funds in domestic and international markets for more than a decade. Metropolitan's President and Chief Investment Officer David Sherman talks about how his firm creates and manages these private funds.
Metropolitan was founded in 2002 by David Nassau, Bob Burke, and me. The firm has grown to 40 people with offices in Hong Kong, London, San Francisco, and New York. We do only one thing. We create portfolios of private real estate fund investments for both institutional investors and high net worth families. We have $2.5 billion in capital under management, and in the past 10 years we've made almost 200 separate private fund investments.
Despite the downbeat economy headlines, commercial real estate markets have stabilized in several key global markets and are recovering nicely in some cases. Institutions and individuals are looking to commercial real estate for yield and growth again, and for diversification of their portfolios. But it's a very different market than in the heady days before the credit crisis. David Sherman, President and Chief Investment Officer of Metropolitan Real Estate Equity Management, explains the differences and what they mean for investors.
An investor that's thinking about investing in commercial real estate should start by looking at two basic groups of strategies: core and non-core. Core would be fully leased properties with long-term stable cash flow, and those are appropriate for investors who are looking primarily for income. Anything that's not core would be called non-core. That could be a property with vacancy, with a big lease rollover that's old and needs repositioning. And those strategies are much better for investors seeking total return. Generally speaking, in the U.S., we don't expect a lot of growth in the office leasing markets because job growth in this country is so slow. There are two exceptions. First, we're seeing great growth in the tech or energy-related markets in the office space. Second, multifamily rental is experiencing phenomenal growth right now for two reasons. First, we're in a mild cyclical recovery. That is, when a young person gets a job, they almost always then go get an apartment. But more important, we're in a secular change in the way Americans own homes. Home ownership peaked at 69% 6 or 7 years ago. It's now about 64%, and we think it's going to drop another 2 to 4 percentage points. Each person who comes out of the home ownership pool becomes a renter. When we're thinking about families of strategies in global markets, the main differentiator is developed markets versus emerging or developing markets. The way an investor looks at an office property in Tokyo or in London or New York is very similar, but that's different than building shopping centers in Brazil. There are a number of themes that are common to all the developed markets. First, income assets have been bid up by yield investors. They're very expensive today, while non-core assets are historically cheap relative to those core assets. Number two, fundamentals, occupancy and rent in most markets have bottomed and are starting to trend up. Number three, it's very difficult to find a new mortgage. Number four, banks and other lenders are still sitting on large volumes of over-leveraged distressed mortgage assets. And finally, in that environment, there are great distressed investment opportunities for investors broadly. There are several strategies that we like very much in the United States. The first is buying foreclosed assets from the bank or buying a mortgage in foreclosing. Typically, those assets have been starved for capital, there's a major vacancy, and an operating manager can reposition them significantly. Second, we very much like fundamentals in the multifamily area, and there we would buy older properties that need a major repositioning. Third, there's a lack of capital in the first mortgage business for non-core assets. There's some very attractive opportunities to make those loans. There are both developed market strategies and developing market strategies that are attractive in Asia. In the developed markets, we like Tokyo best. An investor can buy income assets, older buildings in the 5 central wards of Tokyo, at cash-on-cash returns north of 10% today. In the developing markets, we think the most attractive strategy is recapitalizing residential developments in China. The Chinese banks have been very cautious about lending, which has created an equity opportunity for investors to recap those assets at very attractive returns. Europe is the most interesting continent to look at for real estate investing today. With the illiquidity and volatility in the Eurozone, there are three strategies we like a lot. First, buying loans from banks or restructuring loans with banks that are under distress. Second, buying good quality assets in long-term markets like Paris, London, or Frankfurt that need repositioning. Third, building residential assets in markets where people around the world who are frightened want to put their money, such as London. Metropolitan's investment approach is very clear. We create diversified portfolios of focused experts. For example, if we think it's a good time to invest in office buildings in California, we prefer to invest with local specialists who do nothing but office in California. That gives us better access to transactions and we believe much better leasing performance. We create portfolios of private real estate fund investments. Allows investors to invest in many different strategies in many different markets through one vehicle. That allows us to pick what we believe to be the best manager in each of those strategies. To find the most talented local and regional property operators in Asia, in Europe, and the US, we have boots on the ground in each of those markets. We have seasoned professionals in Hong Kong, London, and throughout the US who do that manager by manager due diligence on all the continents.